Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 61 of Real Talk. Well, everyone was asking when are rates going to come down. We're seeing rates come down, and the 10-year Treasury got all the way down to 3.8. As we're recording, it's about 3.9. We'll see what the Fed does in September. Unbelievable. Now people are talking about 50-point rate cut as opposed to a 25 BIP rate cut. We'll see of how that affects the market and if it does spark more transactions. We are already seeing more transactional volume over the last couple months. And on today's show, we have John Adair, the founder of Glencrest, who recently purchased a deal in Lacey, Washington, a suburb of Olympia, that we talk about. And the uniqueness about this deal is that he bought it out of bankruptcy. And it's now the second deal over the last several months that we have advised a client out of a bankruptcy. And we'll see if there will be more to come. I'm sure you'll enjoy my conversation with John Adair. Welcome to another edition of Real Talk. I'm here with my good friend, John Adair. John, how are you?
Doing well. How are you, Andrew?
I'm doing great. Well, we've got two commonalities, our love for real estate and our love for Northwestern. Should we talk about Northwestern or talk about real estate? I think I'd lose my audience if we talked about Northwestern, but it's up on your show, so we'll talk about whatever we want to talk about.
We'll save that for another podcast, maybe. But always happy to talk about Northwestern. What a great school.
It is great school, and sports that frustrate us, but once in a while make us proud. So John, you're managing partner of Glencrest. For my audience that may not know Glencrest, why don't you tell them what it is?
Sure. Glencrest is a private sponsor of multifamily investments focused on the Western United States. We're about 5 years old now. I started the company in 2019 after a career leading capital transactions at Prime Residential, one of the larger private apartment companies in the Western United States. And yeah, it's been great to date. We've closed 17 acquisitions. Our current portfolio is about 2,000 units. We've sold a few, but mostly we're looking to do long-term investing on behalf of individual investors. Built a team where we've got about 10 people on the team now. And yeah, just really excited about what we're building and where we're going.
And what would you say is your sweet spot in terms of transaction, in terms of size, vintage, any particular qualities that you're looking for on a multifamily deal?
I'd say our sweet spot is that we don't have a sweet spot. This is always the pitch I give to brokers is don't pigeonhole us. We're very much, we have a few sweet spots. We really focus only on existing apartments. We don't develop and we don't do other asset classes. I think in the real estate space, it's very powerful to focus on a single asset class, just because the reality is we tend to use leverage. The market's pretty efficient in terms of pricing. So I respect companies that one day can buy an industrial building, one day can buy an apartment complex, one day can buy an office building, and feel like they're going to deliver above average underwriting and returns on all of those. For us, we've decided that we're going to stick to our favorite asset class, multifamily. But against that backdrop, what we're really looking for are assets where we think the current and future cash flow reflects very favorably compared to the price that we can pay. And where that opportunity exists in the market tends to move around. The example that I often give is there have been times when value add investing is really in vogue. And so a lot of closed-end funds are raised to pursue value add investments. And I've had a few times, there's one situation I still talk about and remember where there were two assets essentially in the same submarket. One was newer, not brand new, so it wasn't core, but not brand new, but pretty well maintained, pretty well managed, not a value add deal, just a good apartment building operating well. And then another one had massive dripping value add potential in terms of the things that everyone is looking for. But we were able to buy so we bought the existing property that didn't have the, just kind of the stable, no value add strategy property at a yield that was way high, significantly higher than the post renovation stabilized yield on the value add property. And I said to the brokers, this is kind of crazy. How is it that I can buy property A at such a much better yield than property B? He's like, all the value add people say they see what a good deal this is, but they raised a fund saying they were only going to do value add deals, and they can't tell their limited partners, oh, we just bought this deal without any value add because it was a good investment. So we're really in business to buy good and great apartment businesses at good and great prices.
Yeah.
We'd love to do great, but we'll do good, but it, where the opportunity is really moves around.
It's interesting of you bringing up that point of some of those funds are stuck based on what they've told their investors. You could argue that's one of the downsides of having a fund and not being able to be as nimble when you just see good opportunities, or you try to get the fund documents to be written as broadly as possible, but it's probable that those investors wouldn't let them have as wide a latitude in terms of the types of deals that they can acquire with their discretionary capital. When we're not talking about Northwestern, I always enjoy having conversations with you about the market, and we're at an interesting time. The 10-year Treasury has come down significantly as we're recording. I don't know where it finalized today, but I know it's sub 4. I've seen a noticeable pickup in transactional volume in the last 30, 60, 90 days, when usually during the summertime there's a slowdown. So before we get into, I know you made a recent acquisition this week, and we'll get into that, but just give your thoughts on just the market in general.
Sure. Investing 101, generally we should be thinking about a return as compared to the risk-free rate. Historically, what you can buy a long-term in the real estate space, what you can buy a long-term treasury for, that's sort of your guaranteed return, and then lenders have spreads above that. Theoretically, equity investors should get more of a return above that. And I think what's been so challenging, honestly, ever since the great financial crisis, so we're going on 15 plus years now, is that our central bank, and this happened all around the world, started really took away the free market from how the risk-free rate was set. They started buying, being active in the treasury bond market, and with few exceptions, few time periods, stayed very active in that for 15 years. So I think we're all still trying to figure out, well, where should long-term treasury rates be? And yes, there's been so much volatility. In my career, to be, now, as you just pointed out, we're below 4%. We were, touching 5% last fall. So to have a 100 basis point swing, and then to have the yield curve inverted with short-term rates still higher, I think it's tricky. It's tricky. one thing that we do is we really try to have a long-term view of where we think rates are going to be, and not pay a whole lot of attention to short-term fluctuations. Now, all that said, because we're a leveraged investor, there's absolutely no question that we can pay more, and many in the market can pay more when treasury yields are lower. But in terms of whether they're going to stay here, I mean, I can make a case for either them getting a lot higher or them going a little bit lower. I don't see, unless the Federal Reserve starts to intervene and starts buying trillions of dollars of treasuries again, there should theoretically be some spread above inflation. So maybe they would get to the, mid threes. I'd be surprised if they get much below that without central bank intervention. And then where should the spread be? I think it should be, we keep it simple. We want an untrended yield that is significantly higher than than where we can borrow, and substantially higher than where the risk-free rate is. So today, sort of lots of other factors, but maybe a couple 100 basis points. So I think when the 10-year treasury is 4, cap rate should be 6.
And are you seeing that?
I mean, there's such a wide variation.
Sure.
I was just reading on, there are a lot of posts because I think KKR just released the metrics on their Katera acquisition, and they just bought a huge portfolio with a low 4 cap handle.
Right.
And I was sort of laughing because it reminded me of, a lot of people are celebrating that there's such a great buying opportunity currently. And that it's just like coming out of the great financial crisis in 2009. And as someone who bought a lot of apartments in 2009, it feels very different. But I'm sort of laughing because what happened in 2020 to 2022 is syndicators who had vociferous demand from individual limited partners to place money into apartments bought B and C assets in growth markets at very low yields and said, this makes sense because we're so confident in the operational upside, the rent growth prospects for these markets, and that the yield curve will be right. And obviously, many of those investments are now struggling. So now I see institutional capital with vociferous demand from limited partners saying we're going to buy Class A assets in urban environments at very low going in yields because we're so confident that about the operational upside, about the rent growth prospects, and because we're confident that the yield curve is going to be right. Of course, there's some serious differences too, but yeah, I think so. That's one extreme. You see institutional assets trading at with 100 plus basis points of, certainly below a short-term risk-free rate, below a long-term rate with negative leverage. And there's a line out the door for those deals, which is really sort of interesting. This is proving my point about how we like to just wait and see where there's less demand. Meanwhile, today, the assets, the type of investments that everybody wanted, low B assets with big value add potential and older and growth markets, people won't touch those with a 10-foot pole. There really is a bid for those.
Yeah, and that's we are seeing that.
So I would say that is one thing that I've seen is a few years ago when there was so much liquidity. There's still a lot of liquidity, but not as much. When there was so much liquidity, every asset, everywhere, A's, B's, C's, urban, secondary, tertiary, there was a huge bid. Now there's more of a broader dispersion of demand. But yeah, I'd say all else being equal, it feels like spot cap rates are generally in the 5 to 6% range. So a little bit lower than I think they probably should be based on all of the factors that I consider. But also not as crazy as they were a few years ago.
Of course. Let's touch upon the geographical locations that you focus on, and then we'll get into the deal you closed this week. Washington State, Oregon, Northern California, and as a lot of my listeners know, in addition to providing legal services, I often try and make strategic introductions between providers of capital and users of capital. And for those that are not located in the West Coast, when I tell them about deals in the Pacific Northwest, they still have not as favorable of a reaction still. And so why do you choose to transact in the Pacific Northwest, and what factors do you see that you like in those regions?
Sure. The first thing I would say about geography is, the old saying about location, location, location. Even within a broad region, there can be huge differences. So,
Yep.
for example, let's talk about Seattle, the Puget Sound area where we just purchased, and we own I guess five assets now. There's a huge difference between being in downtown Seattle and the locate, and being where we just bought in, between Tacoma and Olympia, in a business friendly, much less regulated, much lower cost environment. So the first thing I would say is don't paint you want to, rather than, I think, make broad generalizations about regional investments, it always makes sense to get more local. And that's largely because demand drivers and regulation. I think a lot of what people worry about when they have some negative impressions on the West Coast have to do with government regulation and maybe some of the challenges local governments have been having with homelessness and the like. And again, those tend to be specific geographies, not everywhere.
Yeah, absolutely. That even there seems to be a sentiment around the clients that I work with, capital providers who transacted a significant amount of capital over the last several years in the Sun Belt, are now wanting to come back to the West Coast, and specifically more business-minded jurisdictions within the West Coast. So they may not want to transact in the city of LA, but they want to transact in the South Bay or Orange County or San Diego. And similarly, in the state of Washington and Oregon, there are business-friendly communities outside of downtown Portland, downtown Seattle.
Yeah, exactly. I will say, and since I appreciate what you said about introducing people, we really do think geographic diversity is important to our strategy. So it's always a balance when you're starting a new company. We've ended up doing a fair number of deals in the Pacific Northwest, kind of because that's what we knew and where we got started, but you will absolutely see us invest in other markets. We target 15 markets, Denver and West. And our criteria are we do exclude Southern California for a variety of reasons, mostly just having to do with bandwidth at this point. But outside of Southern California, we cover every market that has a population of more than 300,000 people. And then what we do, investing involves predicting the future. You can't escape it. But we try to do deals where predicting the future, there are fewer variables we need to predict. So then what we do is we look at the long-term rent growth history in those markets. And we want it to be significantly above the general rate of inflation, which all of the markets that we target pass that test. And of course, the future won't always mirror the past. That's a good place to start. Is we try to invest where if the next 20 years in any way, are roughly similar to the last 20 years in terms of rent growth, we'll do well. And often we can comfortably assume something less than that. And then we look into all of the factors that, might make the next 20 years different than the last 20, for example, and think about, we make a probabilistic determination. But to answer your question, like, why do we invest in the Pacific Northwest? So this deal we just bought, over the last 10 years, rents have compounded based on one source at about 6% a year. That's pretty good, like scoreboard, right?
Yeah.
I think a lot of the people who say, I don't like this location or I don't want to be in Washington, Oregon, scoreboard.
Absolutely. Well, let's get into this deal because you bought this deal called Meadowscape in Lacey, Washington, near Olympia, about an hour outside of Seattle. And you were kind. You posted on LinkedIn and you referred Sklar Kirsh of representing you. And within, I don't know, a few minutes or hour or two from that post, I got multiple phone calls or multiple emails saying, Kirsh, I didn't know that you were working on Meadowscape. I've been tracking this deal for a year. Tell me, how did John get it? It was in bankruptcy, unbelievable execution on his part. And I'm sure you got the same feedback. And
no one calls me.
All right. Well, they're calling you through me then.
Yeah.
So tell my audience about this deal, the uniqueness about this deal. You don't normally see a lot of real estate deals in bankruptcy. I mean, we closed one in that I did a podcast on a few months ago about an airplane hangar here in Hawthorne, and now you're the next one of an isolated real estate deal. So tell us the story. How did you source it?
Bankruptcy is a fascinating dynamic. And for me, as you know, I try to not admit this in polite company, but I also studied law and started my career as a lawyer. So that helps because it is complicated. I don't think we'll see that many more bankruptcy situations because I think you and I were talking the other day. These days, because so much real estate is financed in structures that are bankruptcy remote, you get more into workouts or foreclosures, but the bankruptcy remedy, usually it triggers personal recourse.
Yep.
In this case, there was a publicly traded company on the other end, which I think is why it happened, because there weren't people to go after. There wasn't that threat of that. But it was still a fascinating story. So much of this business is about keeping it simple. I honestly think the main reason that we were able to buy this asset is we just stayed really patient and persistent and clear about what we could do. What do I mean by that? It is true that this asset, and so there were several other assets in the portfolio, as this company, great company, by the way, they just got over leveraged and we really enjoyed working with them. Harbor Custom Development Inc., based in Tacoma, Washington. As most companies do that are struggling with their real estate, they started marketing assets for sale. And so all of these assets, it was every 3 months we'd get a call from a different broker. Hey, I'm trying to sell. At the time it was called Tanglewide. Now it's Wild. Now it's called Meadowscape. Trying to sell Tanglewide, trying to sell Meadowscape. Here's this deal. They're still under construction, this and that. They give us the numbers, but they were over leveraged and they needed money. So the asking price was just too high. And it's true, when this happens enough, the third or fourth time you get the phone call, and so we'd say, sorry, we can't pay, $55 million for this half-built asset. It's not worth it. Okay, and then they'd try and go away, and then 3 months later, someone else calls. We've got this deal, Meadowscape. Yeah, we've heard of it. They still want 55 million? Yes. Sorry, I'll send us the new numbers. But then you get them and nope, still not worth 55 million. And again, this happens, people start to get tired. And then what happened is, so then the company filed bankruptcy, then they hired, then generally a whole different set of people come in, start working on the assets. That's generally how bankruptcy works. You got a chief restructuring officer, just the way a lot of people who were there at the beginning and made the decisions that led to the bankruptcy often leave for one reason or another. So then the company they hired an advisor from the East Coast who was great. And they tried, naturally, it makes sense. They tried to sell the entire portfolio, but the portfolio of their Puget Sound multifamily deals, but the portfolio consisted of some completed buildings, some half-built buildings, some construction projects, some land. And again, these are sort of Class B locations. They're not uber core. So it's kind of a tough sell. It was cats and dogs, as they say, or apples and oranges. It didn't naturally work as a portfolio. One group tied up the whole portfolio. Yeah, I know you've heard this story before. Spent some time working on it and then backed out. Well, at that point, there really wasn't a lot of time left, because the other thing about bankruptcy is eventually the judge just said, I've had it. We're going to, give these properties back to the lender, to their senior secured lenders, or, this can't go on forever. That's the whole point of bankruptcy. So we had just been sitting there patiently saying, the only asset we want to buy is Meadowscape, and here's what it's worth. The only asset we want to buy is Meadowscape, and here's what it's worth. And we would regularly follow up. And then we just sort of, on the one hand, you can say the right place, the right time. They didn't have time to spend months looking for a new buyer, and they realized, okay, Glencrest, the price that Glencrest can pay will work for us. So that's how it happened. The other thing, the other challenge with bankruptcy is that it's not really a conventional process, and you have to do your due diligence and your homework first.
I was going to ask you, what did you learn about the bankruptcy process, or what did you not know that was revealed to you, and would you buy a deal through bankruptcy again?
I would definitely buy a deal through bankruptcy again. But I also understand why it's really challenging frankly, for people who don't have a legal background, because, I was good. They post a docket with all the filings and all the information, and eventually it's hundreds and hundreds of pages of hundreds of individual legal filings, and they can sort of provide a path to what's happening with the overall case, which often is an indicator of opportunity. Yeah, and then again, you don't know. I mean, I didn't learn this. I knew it, but it was actually the first time. It was actually the second. It was the second time, but the last time I did this, dinosaurs were walking around outside the building. So, it was a long time ago. But at the end of all this, you go to an auction. There's literally an auction where, after all your hard work and you reached an agreement with the debtor, you might get outbid.
Right.
And there is no guarantee. There is no way to prevent that. Now, what often happens is you can enter into what's called a stalking horse arrangement, where if you sign the deal up early at a given price and then you get outbid at auction, you get a payment for your expenses, and often an extra payment to sort of compensate you for your time. But it's, we're not in it for that.
Right.
We're in it to buy the real estate. So you have to be ready. You have to make a risk, or take a risk. In our case, it was, I think it was calculated. I made a judgment that if we worked really hard and got extra educated about this asset and did all our due diligence in advance, we would be able to pay a price that other buyers showing up at an auction who didn't have the same information and knowledge and hadn't done the same work wouldn't be able to pay. And that's what ended up happening.
No, look, congratulations. It's as we talked about throughout the process, and as recently as this week, it's like, you producing a movie, and you were the executive producer, and you had all of the roles that you were leading, and making sure everyone was rowing in the same direction to culminate with the closing this past week. And no closing is easy, especially in this market, but with the challenges of bankruptcy and the other aspects from the liens and other nuances of this deal, it is not for the faint of heart. And so congratulations on such a terrific closing.
Thank you. I will say, and I don't usually do this, but there is something about this deal that I'm particularly proud of. As we went along, we realized, although the property was complete, we don't buy construction projects. This building was complete, and we'd done reports and hired people to come out and inspect it. We found out that there were a lot of subcontractors who still had a relatively small but significant retainages. They were still owed a decent amount of money, and there was a risk that they weren't going to get paid. And we were about to sign the contract, and at that point I would have put myself in a position to get a stalking horse fee. And the debtor was, who again, I really came to appreciate them, basically said, we're going to trust us. We're going to take care of these subcontractors in some way. And I said, no, I'm only going to do this deal if I see a path to getting real money to the company that the general contractor that built this building and all their subs for the unpaid balance. Now, I want to be very clear. They still took a loss. We weren't able to pay them 100 cents on the dollar, but it was a far better result. The path of least resistance was for this to just go back to the senior lender and for them to get nothing. So I felt really good about doing that. And it's kind of, it's an example of how you can get a win-win. And actually, I think the seller actually really appreciated that. And I think there were some twists and turns and ups and downs, but by the end, I think we all said, like, look, we're doing the right thing. We're working together, and the bankruptcy process is working, where nobody's happy, but everybody's sort of satisfied and gets a fair result with the money available. So that felt good.
Yeah, well, I know that the prior deal that I worked on, where there was an acquisition through a bankruptcy, once they closed, word spread about the deal, and other opportunities came in front of them. So hopefully the same will occur with you and other. If there are,
now I'm on the Sklar Kirsh podcast and talking to Andrew Kirsh, so of course,
wow,
the phone's going to be ringing off the hook.
That goes without saying. In our remaining minutes, I wanted to just ask more on a personal side. I know you alluded to the fact that you did go to law school and were an attorney before jumping to the real estate side. I do talk to a lot of folks, whether they're lawyers, whether they're CPAs, or I don't know, brokers, business managers, and they want to make that jump, but it's not as easy. Oftentimes, people get pigeonholed early in their careers. So how did you make the jump from working at a large law firm to then working for a large institutional real estate company as a principal, as a business person, not as a lawyer?
It's a great question, and I appreciate it. You are right. A lot of people out there are building a career or doing something to make a living, and I think they maybe wish they were doing something else, and it is possible. So I would encourage anyone listening. It kind of goes back to what I was just saying about happy versus satisfied. I mean, every day is not going to be a walk in the park for any of us. There are plenty of days when I get out of bed and I'm like, oh man, I have to do this apartment investing today? But in general, you want that gut feel of feeling good. I really like Ray Dalio as a thinker, and he's got his principles, and the most important two principles are: at any given time, ask yourself, what is true and what do I want? And you need to do that in that order, because if you're denying reality, you're not going to get where you want. But you have to have goals. You have to say what you want. So get very crystal clear about those two things.
So I can't just say that I want to be center field for the Dodgers at 49 years old.
That's exactly right. But you can't. You can't. Man, I saw. I was at the Giants game last night. I can't remember. Did you play center field? Was that your position?
Yeah.
They are having some problem with calling off. Well, I think it was the Dodgers series, which you might have been watching, where they had two blunders in center field. And last night, and Logan Webb pitched a complete game shutout, which was super cool to see. I was there with my kids, but we almost had a center field blunder where it was who's got it, and at the last minute, 1 inch away from colliding. So communication's important. But so this is the point, right? You could not play center field for the Dodgers. We have to be realistic about that. But if you really want to play baseball at your age, there's a way to do it. You just have to say, where could I do it? And knowing you, if you said, I want to work for the Dodgers organization, I want to be in professional baseball, I love baseball, I'd rather have a career in baseball, you could do it. You could do it. Nothing is impossible. Nothing. As long as you're operating from within the bounds of being realistic about what is true, then so many things are possible. That was a very long-winded answer. So what did I do? I was sitting there as a lawyer. By the way, I love being a real estate lawyer, and as you know, I actually still sometimes like to play in the sandbox. But it's true. After a few years, I said, as much as I love the legal aspects of transactions, I'm so interested and intrigued by all these other things that are going on. And I know my personality, I'd be more satisfied if I was doing a lot of this stuff rather than just the legal piece. So I did two things, but I said, hey, I'm here sitting in a law firm's office doing legal work. And I can't just call up and say, hey, I want to, do acquisitions, hire me. I didn't go to business school. I didn't know anything about finance. I didn't know anything about discounted cash flows. I didn't know anything about investment. My dad was a doctor. His dad was a doctor. I didn't want to be a doctor, so I became a lawyer. So what did I do? I did two things. I said, I need to understand the math of investing. I need to understand how this investing stuff works. But I'd just gotten out of law school. I didn't want to go back and get an MBA. So I signed up for the CFA program. And this is the other thing, it takes work. So that's a 3-year series of examinations that leads to a certification that essentially says it's, people say it's as good or actually sometimes better than all the finance courses you get in business school. But you have to study nights and weekends and then take these really, really hard tests. But I knew if I wanted to make the move, it was very important that I do that. So I did it. And then the other thing that I did is I said, okay, well, I'm probably cold calling is and making a huge leap is unlikely to work. So I went in-house for a publicly traded company with a great general counsel, a guy named Scott Burgess, who I said, I'll come work for you and do legal work, but my goal is to get on the business side. So I want this to be a hybrid role and I want you to help me. And that was the deal from the get-go. I was very clear about that. I accepted the job offer on Friday. On Monday, I was taking a week off before I started. On Monday, the company was put in play and started a nasty takeover battle that ended up basically the company ceased to exist. That was sort of the beginning of the end for this company. So I was so excited about this new job. And then the day after I accepted it, it was clear it had a limited shelf life. But again, you have to deal with adversity. So I went to work there. I learned a lot. And then when I was done, the law firm partner, you'll appreciate this, called me and said, I know the company you're working for is kind of ending. One of my good clients who is growing, and this was prime residential at the time, is looking to bring someone on board, and I think you'd be really good for the role. So I went to work for a client, same thing, doing legal work and business work. It was sort of a hybrid role, and then it went from there. So again, I think I was realistic I had a very clear goal about what I wanted to do. I was realistic about what the next step could look like, and then and where my weaknesses are, and then I address them, and that's what happened. But it doesn't just happen overnight.
No,
it doesn't happen by magic. But also, relationships are so important.
Yep.
Because the reality is, I went and worked for this law firm for a year. I'd worked at another law firm. They hired me laterally as a young associate. I worked there for a year and then left. They definitely could have said, like, hey, jerk, where are you going? This is annoying. But I think I did a good job for them. I was very clear about why, and, they had my back. And of course, it's all about the win-win, right? I gave them so much business over the years that it all came back, and relationship matter. So that would be, for anyone listening, relationships are so important. Focus
no law
on your
firm
relationships.
Absolutely. No law firm is upset when their associate goes in-house to a client or potential client, because it just reinforces that relationship. But I didn't know the extent of that story, and it really proves that relationships and network and opportunity and preparation all goes into this. It's not luck. Just you need some luck, but it's not, blind luck is not going to get you there.
Listen to Arnold Schwarzenegger. He has some really good. He's got some good interviews, and he's all about anything is possible, but you have to have a super clear goal. Yeah. Many people actually don't have those super clear goals.
And writing them down. If you write them down and then figure out a path to obtaining them. Well, I haven't had a podcast where we've spoken about real estate, Ray Dalio and Arnold Schwarzenegger, baseball and Northwestern, all in one 40-minute podcast. So I knew, John, that having you on the podcast would create an exciting and interesting and unique conversation, and you proved that it could be true.
I totally appreciate it. By the way, in terms of relationships, you've been such a supporter of Glencrest from the beginning, and have been there every step of the way. So we're really grateful for that and all of the amazing legal work and support you provided. So thank you.
Well, thank you, John. I love working with you, and the fact that Northwestern, or I should say, the fact that several of the Pac-10 teams or Pac-12 teams are now in the Big Ten, it means one thing, that you and I probably are going to see each other in person a lot more than we have in the past.
I think you're right. Down in Los Angeles, I'll be the one making the commute.
LA, Bay Area, Seattle, it'll be fun. It'll be interesting, weird, but fun.
I'm a little scared. I'm scared to think about the NU USC gridiron rivalry. It'll remind me of that Rose Bowl I was at.
No, that was a good game.
So but it was it was still fun. It was still fun. Game. It's all good. It's great. It's
like I said, or like you said, another podcast. We'll delve into the Northwestern football and basketball schedules here. Anyway, John, congratulations on the closing of Meadowscape, and thank you for being a friend and client, and just great for you to come onto the show. I appreciate it.
Thanks for having me. I really enjoyed it and appreciate it.
Thanks, John. Take care.
Bye.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.